ask you the question, let's assume what you're saying is right, and that there's a little bit of expectations that have to catch up. There's some hidden slack in the labor market, and yes, eventually wages will increase a little bit. But the new normal will be a situation where the normal interest rate, nominal and real, will still be very low. And compared to growth rates, if growth rates stay more or less at the level we have them right now, it's not so clear whether we're to the left or the right of the golden rule for some time, which creates longer run, in the new normal, a fragile situation for financial stability. So the question is, don't we need to rethink, for example, the way in which we preserve financial stability in that new normal? And secondly, of course, and that's the more immediate challenge for you as a central banker, how are you going to act and pursue monetary policy in a new normal where the monetary policy space is very limited indeed? And we're not talking about setbacks in the next couple of months. We would be talking about any kind of setback in that new normal that would be substantial, and your policy space will again be exhausted. It's a very depressing view of the world, and I would be curious how you think you can deal with that fragile new normal. Thank you.
Thank you. Well, it's the present situation is one of continuous improvement in GDP growth and labor market and employment. Is this going to end into a situation where basically interest rates will continue to be very low, real rates will continue to be very low? From this viewpoint, I think our situation is evolving, at least if it continues this way, in a way it's kind of different from the rest of the world. Our growth rates are quite higher than most times in the past. Given the past estimates of output growth, potential output growth, we've been over potential output growth rates now for some time. So what is going to be this new normal for the Eurozone? I wouldn't venture in guessing what could be. So, but suppose this is what you are suggesting. Then one conclusion, and I think you hinted at that, one conclusion is that financial stability would become a dominant feature of this new normal. And therefore, by the way, many measures have been already undertaken on that. But it will continue to be the dominant consideration of policymakers to make sure that this fragility doesn't materialize into events that may disrupt such an environment where growth rates will continue to move in the way they're moving today. I would like a normal like that, where growth rates continue and the improvements in the labor market continue to be what we are seeing today. It's pretty clear, however, and I make this point again, that in such a situation, both macroprudential policies and microprudential policies become of the essence. Because the space for macro policies, macroeconomic policies, as you said, restricted. And this is, by the way, one more reason I repeat what I said a moment ago, to exploit this circumstance to recreate space for the fiscal policy, to recreate space on the structural side. I think that's the best way to cope with this new normal of very low real rates is, on one hand, create space, policy space where you can, and on the other, have micro and macroprudential policies that ensure that no disrupting financial stability contingency takes place.